Welcome back to Pesa Forever channel. If you have been watching the markets this January, you know exactly why we are making this video today. We are witnessing something historic in the Indian commodities market. As of mid-January 2026, silver prices on the MCX have officially shattered the ceiling, crossing 2,90,000 rupees per kilogram. That is a number that would have sounded impossible just 2 years ago. We have entered a massive price discovery phase, and if you are an investor, you are probably feeling one of two things right now: the fear of missing out or the fear of buying at the top. Today we are going to cut through the noise. We are going to look at exactly how much silver you should have in your portfolio based on your age, whether you are 30, 40, 50 or 60. We are going to talk about the China factor that kicked in on January 1st, the new tax realities for ETFs, and we are going to bust some myths that might be hurting your returns. Let's get right into it. First, we have to address the elephant in the room. Why is silver rallying like this? It's not just inflation. The game changed on New Year's Day. On January 1st, 2026, China's new export licensing rules came into effect. For decades, the world relied on a steady stream of silver flowing out of China. But that tap has been tightened. These restrictions have squeezed global supply chains overnight, creating a scarcity premium that is driving prices up right here in India. But supply is only half the story. The demand side is even more aggressive. In 2026, silver isn't just a precious metal for jewelry. It is a critical industrial metal. If you look at the booming sectors right now, solar panel manufacturing, the electric vehicle revolution, and the massive hardware infrastructure required for artificial intelligence, they all run on silver. You simply cannot have a green energy transition or an AI boom without high conductive metals. Silver has become the backbone of the 2026 economy. So with prices at all-time highs and demand skyrocketing, how do you fit this into your portfolio? One size definitely does not fit all. Let's break this down by age decade, starting with those of you in your 30s. If you are in your 30s, you are in the prime wealth accumulation phase. You have a long runway ahead of you, which means you can afford to take calculated risks to chase higher returns. The strategy here is aggressive but calculated. At age 30, you should be allocating between 5 to 8% of your total portfolio to silver. Why 8%? Because at this age, your portfolio is likely heavy on equities. Silver acts as a high beta asset. It is volatile, yes, but that volatility often works in your favor during bull runs. By holding up to 8% in silver, you're essentially adding a turbocharger to your portfolio. It can outperform gold during economic expansions while still providing a hard asset hedge against currency devaluation. At 30, you have the time to absorb the price swings to capture that long-term industrial growth we just talked about. Now, let's fast forward a decade. If you're in your 40s, the picture changes. Your responsibilities have likely shifted. You might have a mortgage, children's education expenses, and you're starting to look closer at retirement planning. You can't afford to be as reckless, but you still need growth to beat inflation. The strategy here is to maintain a silver allocation of 3 to 5%. At age 40, silver serves a different purpose. It becomes a balancer. You're likely still heavy in equities, but you need something to offset that equity volatility without dragging down your returns the way pure debt might. A 3 to 5% allocation allows you to benefit from the industrial demand cycles like the current EV and solar boom, but keeps your exposure manageable. If silver crashes 20%, it won't wreck your financial goals, but if it rallies another 50%, you get a meaningful bump in your net worth. Moving on to the critical pre-retirement decade. If you're in your 50s, wealth preservation becomes just as important as wealth creation. You're looking to glide into a comfortable retirement and you don't want any nasty surprises. Here, your silver allocation should be reduced to about 1.5 to 2%. But here's the key for the 50-year-olds. Precise execution matters more than the percentage. I strongly recommend routing this allocation through multi-asset funds. Why? Because as you approach retirement, you don't want the headache of manually tracking and selling silver futures or ETFs every time the market wobbles. Multi-asset funds rebalance automatically. If silver rallies hard, the fund manager books profits and moves that money into stable debt or equity for you. It automates the discipline that is often hard to maintain emotionally when you're managing your own money. Finally, let's talk about the golden years. If you're 60 and above, your primary goal is liquidity and capital protection. You can't afford to have a chunk of your wealth trapped in a volatile asset during a downturn.
At age 60, your silver allocation should be limited to roughly 0.5 to 1%. And the form of investment changes here too. At this stage, you might want to consider highly liquid ETFs or even physical coins for emergency use. Why? Because in an emergency, you need assets that can be converted to cash instantly. While I usually advise against physical metal due to storage issues, for a retiree holding a small amount, having physical silver coins offers a tangible layer of security. But for ease of use, ETFs remain superior for quick liquidation on the stock exchange. Now, regardless of your age, there's a golden rule for risk management that applies to everyone in 2026. It is called the 25% drift rule. Let's say your target allocation is 5%. Because of this massive rally where silver crossed rupees 2.90 lakh, your silver holding might balloon and become 7 or 8% of your portfolio simply because the price went up, not because you invested more. If your allocation rises more than 25% above your target level, you must trim the position. Sell the excess, lock in those profits. This is how you discipline yourself to buy low and sell high. Don't get greedy and think it will go to the moon forever. Trimming during sharp rallies is what separates wealthy investors from bag holders. Let's shift gears to the logistical side of things, taxes. This is actually a bright spot for us. Under the current tax regime, silver ETFs and fund of funds are treated quite favorably. If you hold these units for more than 12 months, they qualify for long-term capital gains tax. That rate is 12.5%. Compare that to physical silver. To get long-term tax benefits on physical bars or jewelry, you usually have to hold them for 24 months. So by choosing ETFs, you cut your holding period requirement in half and enjoy a clean flat tax rate of 12.5% after just 1 year. This is a massive advantage for liquidity and tax efficiency that many investors overlook. Now looking ahead, all eyes are on the upcoming budget 2026. The market consensus is that we'll see strong support for domestic silver mining under the Atmanirbhar policy. The government knows we are too dependent on imports, especially with China tightening its exports. If the budget introduces incentives for local extraction and refining, it could structurally reduce our import dependence in the long run. Before we wrap up, I need to bust 4 common myths that I see floating around in the comments section. These misconceptions are dangerous in a bull market. Myth number 1. Silver is just a cheaper version of gold. This is false. The reality of 2025 and early 2026 has shown us that silver is an independent beast. It has significantly outperformed gold recently. Why? Because gold is driven by fear and central banks. Silver is driven by industry and technology. They are not the same asset. Myth number 2. Silver is a safe and stable investment. Please get this out of your head. Silver isn't safe in the traditional sense. It is volatile. In fact, it is typically 2 to 3 times more volatile than gold. It is not uncommon to see 30% price swings in silver within a short period. If you're buying silver thinking it will be a smooth ride like a fixed deposit, you are in for a rude shock. Myth number 3. Physical silver jewelry is the best way to invest. I love silver jewelry, but as an investment, it's terrible. The reality is that making charges can eat up 20, 30, or even 40% of the value. When you go to sell it back, you lose that money. Plus, purity issues are rampant. Jewelry is a consumption product, not an investment asset. And finally, myth number 4. Digital silver platforms are as safe as ETFs. You might see apps offering digital silver where you can buy for 1 rupee. Be very careful. SEBI has repeatedly cautioned investors against unregulated digital silver platforms. If the platform goes bust, your digital silver might vanish. Regulated ETFs that trade on the exchange are backed by actual physical silver stored in vaulted audits and overseen by the regulator. Always choose the regulated option. So where does this leave us? The year 2026 presents a unique window. The price of rupees 2.90 lakh per kg is daunting, but the drivers behind it, China's export limits and the insatiable hunger of the solar and AI industries, suggest that the floor has risen. Your job is not to go all in on silver. Your job is to size your position correctly for your age. Be aggressive in your 30s, balanced in your 40s, automated in your 50s, and liquid in your 60s. Use the 12-month tax advantage of ETFs, respect the volatility, and have the discipline to rebalance when the market gives you profits. Silver is powerful, but only if it is harnessed correctly within a diversified portfolio. I'd love to hear from you in the comments. Given the current prices, are you buying the dip or are you waiting for post-budget clarity? Let me know your strategy. Thanks for watching, and as always, invest smart.
Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.